To help you with this question, let's work through the scenario together. Here, the receipt from a credit customer of $2,000 has been credited to the payables ledger account. Now, obviously, this is an error. So the best way to deal with this sort of question is to think about what the correction journal would be. Because once you've established that, you can then identify whether there's an impact to the profit or loss account and ultimately the profit. So we think about what the client did post, what they should have posted, and what that correction is going to be. Now, the easiest column to populate here is what they should have posted, because here we know that if you get money from a customer that had previously made a credit sale with your business, that transaction, once you receive the money, should be to debit cash for the amount you receive, and you would remove that customer from your receivables, so they should credit receivables. Instead, what they did is they credited the payables. Now, in the absence of anything else being stated, we assume that the debit to cash is posted correctly because they do not tell us otherwise. But where they credited, and this is what they did incorrectly, is they credited the payables by 2,000. That is clearly wrong. So to correct this particular mistake, what they need to do is they need to remove that credit against payables. So the way we remove it is we simply debit the payables, okay, and that's going to be the 2,000, and that's obviously going to counteract what they did initially. We already know that the cash entry they've posted is correct, okay, they should have posted to cash, debit, they did actually debit to cash, so no correction to cash, but instead what we now know is that they should be crediting the receivable, okay, and that's going to be by the $2,000. Now notice in this double entry, both the payable and the receivable are what we call SFP accounts. In other words, they are statement of financial position ledgers. Both these balances do not go in the P&L. They go in the balance sheet, the statement of financial position, and as a result, there is no implication or no adjustment that is required to profit.